We are witnessing a truly momentous day in financial history, as the Federal Reserve has a new captain at the helm, Kevin Warsh. This is not merely a personnel change, it's a fundamental recalibration of the very architecture of monetary policy, and the implications are already rippling through the overnight sessions. Looking at the futures, we see a sea of red, albeit shallow for now, across the major indices. The S&P 500, Nasdaq, and Russell futures are all showing slight dips, a subtle but significant sign of caution as the market digests the news of Warsh's appointment and prepares for a heavy week. But the real story this morning, the one screaming for our attention, is the volatility index. The VIX futures have surged, a truly alarming jump that signals a dramatic increase in implied volatility. This isn't just a flicker of nervousness. It's a fire alarm indicating substantial anxiety ahead of the open. This spike in fear is coupled with heavy pressure on some of the market's previous darlings. We're seeing prominent tech names like Apple, Tesla, Nvidia, Amazon, and Meta all trading down in overnight futures, with some experiencing particularly sharp declines. This suggests a re-evaluation of risk appetite and a defensive posture as we brace for what promises to be a turbulent week. The financial landscape is buzzing with the reverberations of yesterday's news and the collective wisdom, or warnings, of the titans of finance. The most profound voice of authority, of course, is our new Federal Reserve Chairman, Kevin Warsh. His appointment signals a potentially dramatic pivot in monetary policy direction, one that could redefine the economic narrative for years to come. The market will be dissecting every past statement, every nuance, to glean insights into his approach to inflation, interest rates, and the Fed's formidable balance sheet. The era of Jerome Powell has abruptly concluded, and with it, the market's comfortable predictability in Fed communications may be a thing of the past. Across the Atlantic, Christine Lagarde and the European Central Bank have decided to extend their longest interest rate pause since the era of negative rates. This highlights a divergence, or perhaps a cautious alignment, in global central bank strategies, as the ECB appears to be taking a wait-and-see approach amidst inflationary pressures and a strong euro. Meanwhile, the tech world's luminaries are also making waves. Elon Musk, ever the provocateur, is publicly slamming certain AI models as misanthropic and evil, fanning the flames of the ongoing debate around artificial intelligence and its societal implications. On a related note, Nvidia's Jensen Huang has pushed back against the most illogical thing in the world, the idea that AI replacement fears are tanking software stocks. He sees AI as an accelerant, not a destroyer, of value. Michael Saylor, the indefatigable Bitcoin evangelist, continues to champion his digital asset, declaring it, by design. This steadfast bullishness comes even as MicroStrategy finds itself in an oversold position, reflecting a conviction that few can match. Elsewhere, Jamie Dimon is facing calls to lower credit card interest rates, shining a spotlight on consumer finance and the rising cost of borrowing. And in a fascinating twist, Bill Ackman has made a substantial bet on Mark Zuckerberg's Meta, signaling a belief in the company's AI pivot and its future trajectory, despite today's futures weakness. These strong opinions and strategic moves from these financial titans are shaping the conversations and capital flows across the globe. Let's turn our attention to the bedrock of our financial system, the bond market. This is where the true story of economic sentiment often reveals itself, and today, it's particularly telling. The recent surge in far-forward nominal treasury rates has been a topic of intense discussion, with analysts from the Federal Reserve Board itself asking why old risks re-emerge in an era of Fed credibility. This question takes on a profound new meaning with Kevin Warsh now at the helm. The bond market is not just reacting to inflation data. It's anticipating policy shifts, a potential recalibration of the Fed's approach to its balance sheet, and a fresh perspective on its mandate. The size of the Federal Reserve's balance sheet has been a primer for many, a complex beast that has ballooned over years of quantitative easing. Under Warsh, we could see a renewed focus on its composition and reduction strategy, potentially leading to further volatility in bond yields. The market is effectively pricing in a new regime, one where the long-term outlook for interest rates and the government's borrowing costs could deviate significantly from recent trends. This environment demands vigilance, as any perceived change in the Fed's commitment to inflation control, or its strategy for managing its massive asset holdings, will send tremors through every asset class. The bond market is signaling that the era of easy money is not just ending, but potentially reversing course under the new leadership. The central bank landscape is undergoing a seismic shift, none more impactful than the appointment of Kevin Warsh as the new Federal Reserve Chairman. This is the most critical development in monetary policy in recent memory. Warsh's known perspectives, his past statements, and his alignment with more hawkish or market-centric views will now be the driving force behind the world's most influential central bank. The market is not just speculating. It is actively adjusting to the prospect of a Fed that might adopt a different strategy for combating inflation, managing growth, and navigating geopolitical complexities. This appointment alone casts a long shadow over all future policy decisions. While the US Fed embarks on a new chapter, the European Central Bank, under Christine Lagarde, has chosen a path of continuity, extending its longest interest rate pause. This decision highlights a regional disparity in economic conditions and inflationary pressures, or perhaps a more cautious approach to policy tightening. The ECB's patience could either provide stability or indicate a reluctance to move decisively in the face of persistent, albeit moderating, inflation. Meanwhile, UK inflation data continues to be a point of focus, influencing European market sentiment and acting as another data point in the global inflation narrative. The tech shares, for instance, are pulling back ahead of the US CPI data, underscoring how interconnected these global economic indicators are. The central banking world is not operating in a vacuum. It's a complex interplay of national imperatives and global forces, with Kevin Warsh now holding one of the most powerful levers. The credibility of these institutions, as discussed in the context of the bond market, will be tested in this evolving environment. The commodities markets are sending a mixed, yet cautious, signal this morning, reflecting the broader unease gripping financial markets. Gold, traditionally a safe haven asset, experienced a rather surprising plunge in a market-wide flash crash. This move, as reported by Kitco, warrants close attention. Is it a temporary technical glitch, or does it reflect a deeper, more fundamental shift in risk perception, perhaps signaling a move into the US dollar or even a forced liquidation event? Gold's sudden weakness in a period of rising market anxiety is a counterintuitive development that bears watching. In the energy complex, crude oil futures are testing a critical support level around the $62 mark. The commodities outlook is clouded by geopolitical tensions, with reports of the US readying another aircraft carrier for deployment amid Iran tensions. Donald Trump's actions and the broader geopolitical chessboard are always factors in oil prices, and any escalation could quickly reverse the current pullback. The COT signals, or commitment of traders, data, suggest limited pullbacks, implying that this current dip might find buyers. Natural gas, on the other hand, continues to show broad weakness, despite some regional strength in the Midwest. The overall trend remains soft, indicating ample supply or subdued demand that is struggling to offset localized spikes. These commodity movements, especially gold's flash crash and oil's precarious position, amplify the sense of risk aversion and uncertainty currently permeating the markets, aligning perfectly with the VIX surge we discussed earlier. They serve as a crucial barometer for global economic health and geopolitical stability. The sector landscape, particularly in technology, is flashing warning signs in the overnight futures. The mega-cap tech giants that have led the market for so long are under significant pressure. Apple, Tesla, Nvidia, Amazon, Meta, and Google are all showing declines. Apple, in particular, is experiencing a notable pullback, reflecting a broader re-evaluation of valuation multiples and growth prospects for these heavily weighted stocks. This broad-based weakness in tech is a direct corollary to the surging VIX, indicating that investors are shedding risk ahead of potentially turbulent times. Nvidia, despite its strong AI narrative, is not immune, even as its CEO Jensen Huang dismisses fears about AI replacement as illogical. This sentiment stands in contrast to positive news for Cloudflare, whose earnings beat was boosted by its own AI growth story. This creates a fascinating divergence within the AI space, Strong earnings for some, but broader market skepticism weighing on the sector's behemoths. Elsewhere, Amazon is facing headwinds with Saks discontinuing their e-commerce partnership, a setback for its retail growth ambitions. Microsoft, while forecasting robust Azure growth, faces questions from investors regarding its heavy outlays in the AI arms race. Alphabet, however, seems to retain favor, with Scotiabank maintaining an outperform rating, suggesting some selective strength within the sector. MicroStrategy, the poster child for institutional Bitcoin adoption, is currently considered oversold by some analysts, yet Michael Saylor remains steadfastly bullish. This company's fortunes are inextricably linked to Bitcoin, which, interestingly, is showing resilience while tech futures dip. The sector watch today clearly indicates a shift, a move away from previously high-flying, growth-oriented tech in favor of caution, with investors scrutinizing balance sheets, expenditure, and the true cost of chasing the AI dream. The Crypto Corner offers a fascinating counterpoint to the broader market's cautious tone this morning. While traditional tech futures are painting a picture of apprehension, Bitcoin is showing a degree of resilience, trading slightly to the upside. This relative strength is noteworthy, as it suggests that some investors might be viewing it as a diversifier or even a safe haven against the backdrop of an uncertain equity market and the new Fed regime. MicroStrategy, the corporate titan of Bitcoin investment, is certainly in the spotlight. Despite being identified as one of the most oversold Nasdaq stocks, its founder, Michael Saylor, remains an unwavering advocate for Bitcoin, constantly reinforcing his conviction. His "why design" philosophy continues to resonate with a segment of the market, reinforcing the idea that for some, Bitcoin is not just a speculative asset, but a fundamental shift in financial architecture. However, the crypto space is not without its skeptics and its challenges. Nouriel Roubini, famously known as Dr. Doom, continues his sharp critique of crypto, especially in the wake of BlockFi's halting withdrawals. This incident, reminiscent of past failures in the crypto ecosystem, serves as a stark reminder of the inherent risks and regulatory challenges that continue to plague the digital asset world. So, while Bitcoin shows a glimmer of independent strength today, the sector remains a battleground between passionate evangelists and fierce detractors, with the lines drawn over its fundamental value and long-term viability. As we look towards the formal open of the US markets and navigate the European trading day, our focus must be laser-sharp. The primary catalyst for this week, and potentially a major influencer for the newly configured Federal Reserve under Kevin Warsh, is the US January CPI inflation report, due out Friday morning. This report will be pivotal, shaping expectations for interest rates and the Fed's policy trajectory for the coming months. Any deviation from expectations could trigger a violent reaction across all asset classes, especially with the VIX already signaling heightened anxiety. Beyond CPI, the ongoing discussions around the US unemployment jobs report will continue to influence sentiment, providing another piece of the puzzle regarding the health and trajectory of the US economy. The market will be scrutinizing every detail, looking for signs of inflation persistence or deceleration, and any shifts in labor market dynamics. Given the volatile overnight moves, particularly the surge in the VIX and the broad weakness in tech futures, the market is positioned for a cautious and reactive trading day. Strategic positioning, disciplined risk management, and a keen eye on incoming data and central bank commentary will be paramount. We are in a new era, with a new Fed chairman, and the old playbooks may no longer apply. Expect choppy waters and be prepared for rapid shifts in sentiment. Today marks a watershed moment in global finance. The appointment of Kevin Warsh as the new Federal Reserve Chairman fundamentally recalibrates the entire monetary policy landscape. This is not just a changing of the guard, it is a redefinition of the path forward for the world's most influential central bank. Against this backdrop, the markets are already showing significant signs of unease. The dramatic surge in the VIX, coupled with the broad pressure on mega-cap tech futures, underscores a palpable sense of heightened risk and uncertainty. Investors are clearly taking a defensive stance, grappling with the unknown implications of Warsh's leadership and bracing for the critical US CPI inflation report later in the week.